Ladies and gentlemen, good day and welcome to Yatharth Hospital's Q4 and FY'24 earnings conference call, hosted by SMIFT Limited. As a reminder, all participants' lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Dhara from SMIFT Limited. Thank you, and over to you, ma'am.
Thank you, Sejal. Good afternoon, everyone. I, Dhara from SMIFT Limited, welcome you all to the Q4 earnings conference call of Yatharth Hospital. From the management side, we have with us Mr. Yatharth Tyagi, Whole-Time Director, Mr. Amit Kumar Singh, the Group CEO, Mr. Pankaj Prabhakar, the Group CFO, Mr. Deepak Tyagi, President, Strategy and Finance, and Mr. Neeraj Vinayak, Head, Strategy and Investor Relations. I now hand over the call to Mr. Yatharth for his opening comments and to take it forward. Over to you, Mr. Yatharth.
Good afternoon and a very warm welcome to Yatharth Hospitals and Trauma Care Services Limited's earnings conference call for the quarter and full year ended March 31, 2024. I have with me Mr. Amit Kumar Singh, our Group CEO, Mr. Pankaj Prabhakar, our CFO, Mr. Deepak Kumar Tyagi, our President of Strategy and Finance, and Mr. Neeraj Vinayak, who has recently joined as the Head Strategy and Investor Relations. We have uploaded our presentation on the exchange and the company website, and I hope you all might have received and have had an opportunity to go through it. In an ever-evolving landscape of healthcare, Yatharth Hospitals have stood resilient and showcased unwavering commitment to excellence. Throughout the fiscal year, our team's dedication, strategic vision, and operational efficiency have propelled us forward, enabling us to surpass expectations. Given the swift pace of modern lifestyle, patients increasingly prioritize treatments that ensure safety and swift recovery. I'm happy to share that robotic surgeries have now seamlessly integrated into our standard medical procedures, with around 115 robotic surgeries already completed till date. We have indeed taken the lead in conducting the first robotic surgery in Greater Noida region. Till date, we have installed 3 Da Vinci X surgical robots and 1 Stryker orthopedic robot across our 5 hospitals. This quarter saw us perform some remarkable life-saving medical procedures, including abdominal aortic aneurysm repair, TAVR, for an African international patient. I'm also proud of the 7-hour neurosurgery on a young child for removal of a rare brain tumor, expanding 2 kg for 18 excruciating months. Yatharth Hospitals have an unwavering commitment in upholding the most rigorous corporate governance standards, thereby ensuring utmost transparency and accountability to all valued stakeholders. Thus, I would like to highlight that our company is in advanced stages of finalizing a prominent Big Six audit firm and will be appointing them as statutory auditors in the coming time. Speaking on the performance, during Q4 FY'24, we invite state-of-the-art radiation oncology and nuclear medicine center at our Noida Extension facility, marking a significant milestone in redefining cancer care services in the region. Equipped with cutting-edge technology and comprehensive facilities, including a linear accelerator, Electra Versa HD, brachytherapy, and PET-CT scan capabilities, we aim to provide comprehensive cancer care services under one roof to our patients. With oncology now contributing nearly 10% to our revenue stream in Noida Extension Hospital, I anticipate significant growth in the current fiscal year with the establishment of cancer radiation line. With addition to this, robotic surgeries and expansion of organ transplant procedures, I am confident of a case mix shift towards more specialty treatments which we have already displayed and should further drive our higher ARPOB. With Asia's largest international airport, the Jewar Airport, expected to commence this year, we have already set up dedicated team of international marketing professionals to expand the medical tourism business for the group. To cater to these international patients, our Nod Extension facility has undergone some renovations, including creation of a dedicated international patient floor and a lounge designed to provide a comfortable and welcoming environment. Furthermore, we are strategically developing the infrastructure of the additional 200 beds at a Greater Noida location with a focus on catering to international patients. Our team has been organizing facilitator meets and our doctors are constantly going and doing OPDs in countries like Africa, Iraq and CIS. I am glad to announce that Yatharth hospitals have achieved industry-leading growth in revenue and profitability during the quarter and full year ended March 31, 2024. We have delivered stellar results with our revenues surging by 29%, reaching rupees 6,705 million in financial year 24. This growth trajectory was complemented by a 35% increase in EBITDA, reaching rupees 1,799 million, with the margin expansion of 113 basis points to 26.8%, further highlighting our balanced approach towards growth and profitability. A profit after tax surged by 74% to rupees 1,145 million during this period. In the fiscal year ending March 31, 2024, Yatharth hospitals experienced notable advancements. Our expansion strategy, encompassing both organic and inorganic approaches, saw significant milestone in February 2024 with the execution of a definitive agreement of the complete acquisition of Asian Fidelis Hospital in Faridabad, Haryana, now rebranded as Yatharth Hospital Faridabad. This strategic move with the purchase consideration of INR 1,160 million underscores our commitment to growth through inorganic mode and is in line with the commitment to acquiring one hospital each year through financial 24 to 26. This share purchase agreement was completed on March 28, 2024, and the hospital was operationalized on May 12, 2024, thus expanding our presence in North India region, particularly strengthening our presence in Delhi NCR markets. Throughout our hospital network, we have observed a consistent uptick in occupancy rates, achieving an overall level of 54% for the fiscal year. Our Noida hospital stands out with an impressive occupancy rate of 89%. Furthermore, our Greater Noida facility has seen an increase in occupancy to 67% now. We anticipate this facility to achieve optimum utilization in this fiscal. Our Noida extension has been growing rapidly, with current utilization reaching 44% versus 31% in previous year. And this facility will be reaching optimized occupancy level by the next year. Furthermore, our Jhansi hospital is progressing well, with an occupancy rate of 34% in Q4 2024. As we continue to ramp up operations and enhance services offering, we expect to see continued growth in occupancy at our Jhansi hospital. In summary, the quarter has been marked by impressive double-digit growth across most of our specialties and super specialties. As part of a strategic realignment towards super specialty treatments, we have observed a steady decrease in our share of internal medicine and a positive impact on consolidated ARPOB levels by increase in the high-end super specialty departments. Among all hospitals, Noida Extension Hospital registered the highest share of revenue coming from super specialties and thus witnessing highest ARPOB level of rupees 35,074 during the quarter. I would like to hand over the call to CFO, Mr. Pankaj Prabhakar, for the financial updates for the quarter. Over to you, Mr. Pankaj.
Thank you. Good afternoon, everyone. I am pleased to announce that Yatharth Hospital has achieved industry-leading growth in revenue and profitability during the quarter and full year ended March 31st, 2024. Let me take you all through the quarterly performance first, followed by our annual performance. During the quarter, Yatharth Hospital achieved a revenue of rupees 1,777.5 million, reflecting a substantial YOY growth of 24%, driven by an improvement across most of our specialties and higher ARPO level. Our inpatient revenue were up by 23% YOY, while outpatient revenue witnessed an improvement of 26% YOY during the quarter. Our company reported an EBITDA of rupees 465 million for the quarter, up 21% YOY, while our margin stood at 26.2%. Our profit after tax exhibited remarkable growth of 121% YOY and 30% quarter-over-quarter to reach rupees 383 million, primarily attributable to lower finance cost during the reporting period. As mentioned earlier, we are witnessing the full impact of debt reduction which has reduced our finance cost by 93% YOY. During the quarter, we have secured a debt of approximately 800 million to facilitate the transfer of pending debt liabilities associated with the Asian Fiddler Hospital onto our books. This strategic move allows us to enhance cash efficiency for allocation towards other growth initiatives. That said, we remain committed to prudent financial management strategies and optimize our capital structure for future endeavors. As a result of our strategic initiatives, our PAT margin expanded significantly by 953 basis points YOY and 390 basis points quarter-over-quarter, reaching an impressive 21.6%. Our average revenue per operating bed, ARPO, for the quarter was 29,266, up by 6% year-over-year. The improvement was driven by a consistent shift towards higher complexity procedures observed across various specialties, with gastroenterology, pulmonology, orthopedics, and oncology emerging as key drivers of growth. Furthermore, our bed occupancy for the quarter reached 57%, making a significant improvement compared to 49% in Q4 FY'23, indicating enhanced operational efficiency and utilization of our facilities. Let me now briefly touch upon the consolidated full year numbers of the company. Our revenue grew by 29% YOY to reach 6,705 million. Our inpatient revenue demonstrated a solid 30% YOY growth, while outpatient revenue witnessed an increase of 20% YOY. Our EBITDA for the full year remains at rupees 1,779 million, up by 35% year-over-year, with margin expanding by 113 basis points to arrive at 26.8%. Our profit after tax increased by 74% YOY to rupees 1,145 million, and PAT margin stood at 17.1%, expanding by 443 basis points. With our constant endeavor to shift towards more super specialty treatment, our ARPO for the full year is rupees 28,571, an increase of 8% year-over-year. Our Noida Extension Hospital delivered the highest ARPO of rupees 33,994 for the year, witnessing an improvement of 12% YOY. Bed occupancy for FY'24 stood at 54% versus 45% for FY'23. During the quarter, the revenue contribution from government business remained on a higher side at around 40% of our top line, which, coupled with a rise in outstanding receivables from government entities amidst election, resulted in high receivables during the year end. We are in touch with the department and expect receivables to come down significantly by coming quarters. Our balance sheet continues to be strong with a net cash position of rupees 1,556 million. We remain dedicated to deploying these funds strategically to drive further growth and value creation. Our returns indicators remained healthy with ROCE at 32% and ROE at 22% despite an expansion in our capital base. As we progress, we are well positioned to capitalize on the opportunities ahead and drive sustained value creation for our investors. Thank you for your trust and continued support. With this, I would like to hand it over to the moderator for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Pujan Shah from Molecule Ventures. Please go ahead.
Hi, sir. Am I audible?
Sir, may I request you to please use your handset?
Yes. Am I audible now?
Yes, sir. Please go ahead.
So my first question would be on the Jhansi Orissa hospital. Just wanted to know, in terms of ARPOB, if we are looking on a YOY basis, it has been degrowth. We are seeing a degrowth of 30%, while occupancy has been improved at 62%. Just wanted to know what we are visioning about this hospital and how we have been evolving, and what our expectation limits to for next 1 to 2 years.
So for Jhansi Orissa Hospital, the occupancy has shown good growth. And if we talk about ARPOB is increasing because, some of the government scheme business that we're doing in this hospital that we recently got aggregated with. So in the last earnings calls, we mentioned that, some departments like ECHS, Railways and Ayushman have been onboarded in Jhansi Orissa Hospital, and with the occupancy of those government schemes increasing, ARPOB in those departments tend to be lesser. That is why there's a dip in the ARPOB. But overall, we are happy with the increase in the IPD volumes there. And we feel that in the coming quarters, this hospital in terms of occupancy will rapidly increase also.
Okay. So, any broad idea about what ARPOB we can achieve over this specific facility, and what we can guide about in next 1 to 2 years for this facility?
So I think ARPOB should be on an increasing trend in a year to a couple of years in this facility. Reason being that now, as we have these government panels on board, now it is also giving us the chance to fully operationalize our critical care and ICU beds. And now all the doctors there are complete. So we feel that in the coming quarters, as our volume of critical care patients in Jhansi increases, the ARPOB should increase much further.
And also, just to add, if you see the super specialties business are growing in Jhansi, So this year would be the much more numbers we'll achieve in terms of super specialty, which gonna add in our, ARPOB. So anything by this financial year, I think you will see a good ARPOB by the second or third quarters probably.
Okay, got it. And on a commentary, we have said that we will try to add one hospital or one facility each year by FY'26. So that what, let's suppose if we conclude, we can say that we will add two more facilities in the upcoming two financial years. So any broad idea on what our capex would be and what cost per bed we are eyeing in terms of, and third, which area we have been looking to for acquisition of new facility?
Right. So, we are looking in the areas of primarily North India, and that too, if I talk about, outskirts of Delhi NCR market, and Uttar Pradesh, Madhya Pradesh, Haryana. These are the areas where there's still a lot of potential, we feel, as the population is, growing, urbanization is happening in these areas. There's a huge scope for good super specialty hospitals. And there are a few hospitals that, we are eyeing for acquisition in these areas. As far as the capex per bed is concerned, see, if you look at it, recently we acquired the hospital in Faridabad. And, it is when we expand it and we add medical equipments to it. So we are paying roughly around 150 crores for a bed capacity of close to 200 beds. So coming to the capex per bed of 60 lakhs to 70 lakhs roughly. So this is what we feel would be a similar capex per bed if we want to acquire an existing facility. But then obviously, there are some options that are available on O&M, on lease model. That is something also we are exploring.
Okay. So just wanted to get a brief idea on the acquisition of the 200 beds of Faridabad. So if we consider the total cost is 116 crores plus the machinery expense which we have spent. So on 116 crore, it seems a bit cheap compared to when we are looking at the similar facilities in the same area. So we get a very good deal about this thing. So just wanted to know how was the hospitalized structure well before we have been acquired to, and what we need to be get ramped up on and on more than 150 crores. We need to spend anything else for this facility to be keep running on?
No, so I think that is the total amount. I don't think 150 crores is the right amount that we feel for overall capex plus the purchase of this hospital, and primarily that involves the robots that we are putting up. In fact, last week itself, this hospital has been commenced operations, and we've already placed a surgical Da Vinci X robot there. So most of the capex is being done there, and some little is pending, and we feel that this hospital should ramp up very well. Faridabad in itself being a huge hospital market, the drainage from the surrounding areas, including Mathuras, Palwal, Sona, is huge in Faridabad. So we feel that it's a good catchment area. Plus, this hospital already, has healthcare insurances and some of the government empanelments from day one. So that is really helping us to, ramp up the occupancy in this hospital in the coming quarters. And another point is the doctors that are available in Faridabad and the doctors who have already joined us in this hospital, when this operation this month itself. These are some star doctors that we feel have a good clientage along with them. So we are very optimistic about this hospital, and it should ramp up in occupancy very, very soon.
Okay, got it. Thank you so much, sir. I will turn back in the queue.
Thank you. The next question is from the line of Deepak Singh from Barclays. Please go ahead.
Yeah, hi sir. Congratulations for posting such a wonderful number. So I just wanted to ask, like, for the next 3 to 5 years, can we expect this revenue like 40%, which you are like growing like for last 40%? So can we expect for 3 to 5 years, next 3 to 5 years?
See, we have had a revenue growth of 29% year-on-year basis and EBITDA percentage of 35% growth year-on-year basis. We feel quite confident in sustaining these growth for the years to come. We have occupancy ramp up yet remaining. We have ARPOB that is growing on even quarter on quarter. So we are quite confident of maintaining the growth margins that we have shown in the last few years, in the years ahead to come also.
Okay. So, like, are you planning to, like, open a hospital in, like, Bihar, somewhere there? Or, like you are targeting only Delhi, NCR, and Haryana?
So we are looking at North India, so that includes Uttar Pradesh, and on the border comes Bihar. If there's a good opportunity there, it does sort of come within our territory of expansion. We will look into it. We have some leading doctors who belong to those regions. So if there's a good opportunity available there for acquisition, that is something we will look out for.
Okay. Thank you. Thank you very much.
Thank you. The next question is from the line of Sumit Gupta from Centrum Broking Limited. Please go ahead.
Hi, am I audible?
So may I request you to please use your handset?
Yeah, am I audible?
So can you come near to the mic and speak, please?
Yes, is it fine?
Yes, sir. Now it's loud and clear.
Okay. So I just want to understand about the receivables part. So it is short of a lot this year. So just want to understand a bit on that.
Yeah, so receivable has, gone bit up, and the reason being that, as Mr. Pankaj mentioned in the commentary, that there has been increase in the government business, so earlier it was close to 1/3, and, in the latest quarter, and now for the fiscal, it has gone to roughly very close to 40%. So with the government business increasing and also some delay in the from the segments that we receive money in, that is the reason receivables has gone up. And primarily, if you look at it, these are three government schemes. So one is ESI, second is ECHS, and third is CGHS. Primarily, the debtors that we have are in these three government schemes. And yes, maybe because of the elections here, maybe because of the coincidence in Q4, the payments have been slow from the government side. But we feel, as government has displayed in the past, that in the coming quarters, this should normalize very soon. So that's the reason for the receivables going up.
Okay, so so just want to understand about the payer mix over the next 3 to 5 years. How do you see that panning out? Government scheme coming down or insurance catching up? So just want to understand on payer mix.
See, we've also mentioned this earlier that we are focusing much more on increasing our RPOP. Focusing on the payer mix and optimizing that is not something we are thinking right now, as long as, our RPOP is increasing. So, and another reason why the government business has increased recently is because of oncology starting. We have started radiation oncology, and so that has also led to increase in our medical and surgical volume. And now oncology has good rates in CGHS and government. So this is why it's okay to take, government business when it comes to oncology and high-end super specialties. So as long as we are increasing business in those super specialties like oncology, like transplant, and RPOP is increasing, we are fine with the payer mix. But yes, we also do expect, our healthcare insurances and cash patient segment to increase at a faster rate, given the brand recognition among this area and given the leading star doctors that are now in the pipeline to join us from the coming quarter onwards.
Understood, sir. So just one last question. So if I look at the OCF to EBITDA conversion, so it is very low. Just want to understand, not for this year, but over the last 3 to 4 years. Just want to understand on that part. Why?
Can you repeat what is low? What to
EBITDA conversion?
Right.
EBITDA is increasing. I'm not following your question properly, Sumit. This is Deepak this side.
Basically, overall, if I compare it to the peers, so it is lower with respect to the like big players in the Delhi NCR region only. So just want to understand on this part, why is the EBITDA to OCF conversion lower?
One thing, because the cash accumulation is low. One reason Mr. Tyagi just explained to you, because there is a significant investment going on the debtor side. But if you're talking about the margins are pretty decent. We are, year-on-year basis, we are increasing. We are close to 27% now, which is around 200% basic point from the last year. So yes, your question is right, that how the EBITDA is turning into the cash accumulation. So that's basically because in this year, not a happy situation. We are not liking it. But, Mr. Amit Singh and Mr. Tyagi are working very hard to have these amounts realized as early as possible. But most investment of our operating cash flows are getting onto the debtor side, and that's why you were saying that the cash accumulation is slow.
Understood. So, sir, over the next 3 to 4 years, or at least 2 to 3 years, how much EBITDA margin expansion do you see?
EBITDA margins, we are quite good in terms of EBITDA margins are concerned, and we expect the margins to be sustainable, because, even though new hospitals are coming up, but there's still a lot of occupancy growth that's going to happen in our existing hospitals of Greater Noida Nord Extension. So overall, EBITDA margins are quite sustainable even in next 3 to 4 years that we have currently.
Understood. Okay. So last question on the ARPOB. So basically, you're saying you are not focusing on improving the payer mix. It will just be on the basis of case mix as well as introduction of new robotic surgery. So that will lead to growth in ARPOB. Is it fine?
Yeah, it's absolutely fine. So as long as it's not hitting us badly. See, if you look at it, we have a bed capacity, and then month on month our super specialties are growing. So I think we are okay with this current mix as of now.
Understood. Thank you, sir.
Thank you. The next question is from the line of Tushar Manudhane from Motilal Oswal Financial Service. Please go ahead.
Yeah, thanks for the opportunity. Sir, just on the Noida hospital per se, we are now almost at 89% occupancy. So, and even the Greater Noida, we are at like 67% occupancy. So, any scope to add more in terms of ICU beds so that, we are able to have better realizations in these hospitals?
So first, we'll take a Noida. So as it's 89% of occupancy, so only first thing is that there is no bed capacity available that we can add. There is no space where we can increase our, ICU beds or any other this thing. Only thing Noida will give us the growth is about the changing of the specialty and revenue mix. So if you look at it, even our IPD revenue and OPD revenue, the per patient realization has increased, and that is what we were working on. Coming to the Greater Noida, yes, we are, as Yatharth had earlier stated in his commentary, that the 200 beds we are adding in Greater Noida. So as of now, Greater Noida is still 67% of occupancy, still around 12 to 15% occupancy is there. I mean, left, that inventory is there. And then adding a 200 beds would give us a good flexibility to add more critical and super specialty beds. Understood.
So considering this, and in fact even Noida extension has the scope to expand the bed capacity. So if I have to factor this, then how much of capex we will do in FY'25 and 26?
So the capex that we have, taken for the expansion of our existing brownfields, because, it's not a greenfield expansion, it's brownfield. So we feel 60 lakhs to 65 lakhs per bed capex is required in terms of our both Nord Extension and Greater Noida Hospital coming up. So if 65 lakhs approximately capex per bed for a 450 beds. So that is there. And that's, yes, again, for acquisition, as I mentioned earlier, that capex would be somewhere around 70 lakhs per bed that we're looking out for. Depends upon the number of beds of acquisition that we're going to add.
Understood. And lastly, so what kind of valuations, if at all you are acquiring? So first of all, on the strategy in terms of acquiring, like in terms of earlier cases, you have done acquisition where the hospitals were sort of built but were available at a very good or a compelling valuation. So how do you think of, acquiring subsequently now in the coming years?
So
or, now you'll have to pay premium?
So, so far we have acquired asset at a fairly reasonable valuation. And when I said that, somewhere around 60 to 70 lakhs per bed capex is what we look at while looking to acquire a hospital, so that sort of gives a fair value estimation. But see, it is for us also depends a lot on the area and what is the catchment. It is just not that we are looking at a certain valuation, that is what propels us to do an acquisition. It has to be fit in the overall strategy. And we have always had this strategy. We have been present in the areas which are growing, where the population is growing, and which is catering to outskirts and nearby huge drainage areas. So that is also key, and this is why, Faridabad we feel has a huge drainage. This area of Greater Faridabad is coming up with a lot of societies, population increasing there. So there are other factors that also goes into when we decide an acquisition, not just the valuation. And we feel if those factors are catered into play, we can always look to increase and decrease certain valuation depending upon the geography that hospital is located.
Understood. Thank you, sir. That's it from my side.
Thank you. The next question is from the line of Dhruv Bhatia from AUM Fund. Please go ahead.
Yes, hi. Can you hear me?
So can you come near to the mic and speak, please?
Yes. Can you hear me now?
No, sir. May I request you to please use your handset?
Hello.
Yes, sir. Now you're audible.
Sir, congratulations on a good set of numbers on the P&L, but we are not, the balance sheet doesn't look too good, because if I analyze between 23 and 24, your sales have gone up by 150 crores, but your debtors have gone up by 120 crores. So the operating cash flow after working capital changes is zero, though you have a very healthy EBITDA. In terms of cash collection, has been almost is almost negative from operations after working capital. So I'm not understanding that, even if I take 33% of your last year's sales going to the government, where you have a receivables issue, and this year it's increased to 40%, the sales to government have increased by 120 crores and the debtors have also increased by 120 crores. So basically, for your incremental government sales, you have not collected at all. Is that the way to understand it?
No. So, definitely there has been, increase in the government business and some delay from those payment side. That's one aspect. And also, the other of the total debtors we have, that also includes some private insurances also, some TPAs. So overall is what you see is, yes, a minority would be in the private insurances side, a majority would be on the government side, but that is how it's coming up.
Yeah, but so on the P&L is looking very good, but on the operating cash flow side, the performance has been pretty poor, given that almost the entire incremental sales, 150 crores, 120 crores has become debtors. Can you provide us some sort of, aging for these debtors? They are due for how long? Your 220 crores odd of debtors?
See, the total debtors we have, as I earlier mentioned, these are primarily from three government schemes, ESI, CGHS and ECHS. These three government schemes have a UTI portal, which is an online website where each details of each patient is visible with the exact amount. And on the UTI portal, there's also a mechanism where you can see at what stage the government is checking the bill and what stage the funds are about to be released. So there's usually stage 1, stage 2, stage 3. All these three stages are available on the UTI website for our debtors to see, and we feel that with the oncology business increasing, that is, and coupled with the slow payment from the government, it has increased, but it is only a Q4 reflection, which is reflecting the overall year-end balance sheet. As we proceed further with the new financial year coming up with Q1, Q2, this debtors will significantly come down, as always does with these three government schemes. Plus, with the additional of a cash and insurance revenue increasing, we are quite confident in the coming quarters the revenue that is being generated in terms of the cash flow would be at an optimized and at a good level.
Good observation, but numbers are to be seen. See, you were saying that there is an increase from 108 crores to 227 crores, but you have to appreciate that in the same time, the revenue has also grown up by 30%. So even if you take the same thing, that number should have been anywhere between 145, 146 kind of thing. So if you deduct that, it would be in the range of, I'm not saying that, the debtors have not gone up, but saying that the entire revenue generation has gone into that, that's not correct. So there is a question that, what is this, 80 crores kind of thing is coming. And as Mr. Tyagi mentioned, that, there is a slackness from the government side, and it happens. At times, the government comes, and they release the fund, and immediately the debtor, inventory comes down. We are cognizant of the fact, and we have, we are basically putting it across very clearly that, we are working very hard, and we are trying to, bring this down. And, there is a significant effort on a, on a top line side, on a profitability side, and the same impetus we are putting onto the debtors collection as well. But debtors increase is to be seen in the light of The increase in the revenue as well. It's not in the absolute numbers only.
So, sir, I've looked at that. 150 crores sales have increased and debtors have increased by 120 crores. I'm looking at the sales increase as well, and that's why operating cash flow after working capital changes is negative.
Yes, and as we said that, in the coming quarters, operating cash flow will increase as the debtors will come down and, we are in contact with those departments. So you will see a significant change in the cash flow from the coming quarters ahead.
Okay, thank you.
Thank you. The next question is from the line of Prirana Amana from PNA Capital. Please go ahead.
Yeah, am I audible?
Yes, ma'am, you're audible.
Yeah, sir. Hi. Congratulations on a good set of numbers. You all have been very consistent since IPO time. So my first question is, what has been the payer mix for FY'24?
So the payer mix, as we mentioned that the government category is very close to 40% now in terms of the total top line, and the remaining is then equally divided between cash and TPA segment. So somewhere, around, let's say, 33% for both cash segment as well as the private insurance segment.
Okay, sir. And my last question is, I think last quarter we saw that the Supreme Court was, talking about standardization of rates in private hospitals. So how do you see this? Like, is it going to benefit us, or how do you see this? If this law is implemented, how do you see this going forward?
So, this already, the body of the private health segments, AHPI and Net Health has already made the representations. And I think recently we got that the Supreme Court had shown that observation about the PIL filed by the, Ophthalmic Society of India, then said that it's not, practically possible to have a, same rate for across the specialties and across this thing. So it's a matter going on, and we are pretty, confident that that observation will not be, applicable for across same rate for across this thing. So we are not worried as such.
Okay, sir. Okay. Okay. That's all I had, and congratulations and all the best luck for the next financial year.
Thank you. The next question is from the line of Prateek Podar from Bandhan Mutual Fund. Please go ahead.
Yeah, hi. 2 questions. So one is when I
Sorry
look at
to interrupt you,
for...
sir. May I request you to please use your handset?
Is this better?
No, sir. Your voice is very less.
Oh. I hope this is better now.
Yes, sir. Please go ahead.
Okay. Just one question. When I look at RBOC for Noida extension, on a YOY basis or let's say even on a QQ basis, the expansion is not material versus the case mix where oncology has become 10%. So can you just double click and help me understand as to why that has happened? Because oncology, I would have thought would be at least 2x of the base RBOC. And to that extent, the numbers look slightly muted, at least in the Noida extension side.
No, so if you look at it, last year, the Noida extension RPOP was, close to rupees 30,000. And if you look at Q4 of this year, that is very close to 36,000 rupees. So that is an increase of roughly more than 5,000, in that. Yes, in the overall year, the RPOP looks a bit less than that. But if you look at the Q4, that is where the significant volume of oncology has come up. So this is why we feel confident, and now with the new fiscal and new quarters coming up, this is much more, this will be much more visible. And an increase of 5,000 rupees of an RPOP is primarily because of the shift in the case mix.
Yeah, but when I look at it sequentially, right, it's just gone up from 34,000 to 35,000. And you are saying that, in Q5 we have seen a material ramp up of oncology. So in that case, the RPOP should have increased further, right? Isn't it? And even on a YOY basis, if I see exit to exit, which is Q4 FY'23 to Q4 FY'24, the number is 32,173 to 35. So it's just a 3,000 rupees increase. So slightly puzzling over here.
So we feel that this amount of increase is significant when it comes to these treatments, and then you have to also see the in line that when these treatments have recently started, the volumes that they have to generate. So medical and surgical oncology is what we were doing earlier, right? And that is what the government business has increased in. But when it comes to radiation oncology, that is that is what boosts our ARPOB quite a lot, because it is mostly on an OPD basis. That radiation line has just started in Q4. So once those volumes increase, that is where you also see much more impact. But the impact that we still feel, if you compare it to the group average, what we're doing there and this. So I think we are on the right track as far as the ARPOB increase in extension is concerned. And I'm quite confident that, in the coming quarters, this ARPOB in node extension will even touch rupees 40,000.
Understood. Thank you. The second question is, with insurers, has there been any change in card rates? Have you gone on for an increase in FY'25?
Yeah. So for one of the hospitals, because it's once you freeze the rate, just 2 years the rates are frozen. So this year we had a negotiation for our Noida hospital. I think 3 months back we did that. So in the impact we will see, and probably next year we'll have a greater Noida and Noida extension.
How much was the increase for Noida hospital, sir?
So totality, I think it's difficult to say, because it's 135 odd procedures are being discussed and got the rate. But I think anything between, it will have an impact of 6, 7%, 8% kind of impact will come. And because there is a annual revision of the rates as well. Every hospital does it. So we have also had some corrections of our own SOC. So it will also have some impact.
Got it. And this last question on the debtors, I think it has been asked multiple number of times. Is this slightly seasonal because of elections that you are seeing an increase, or this is a year-end phenomena, or how should we think about the increase in debtors? Is this something which will always happen, that in Q4 you will see a rise in debtors and then it liquidates in Q1, Q2? That is the way to think about it, as long as your payer mix remains at 40% from government?
No, I think even at a payer mix of 40%, the debtors should come down much lesser. And it could, as we said in the commentary as well, that elections could have an impact on this. But, it's a very quarter on quarter, it really depends upon when the government is getting funds. Sometimes, in March itself, some funds are released, sometimes in April. So it's a very subjective thing, the government payout that is supposed to be. But we are pretty sure that this level of debtors that are currently there should significantly reduce in the coming quarters.
And since 45 days have been passed, can we assume that there has been some liquidation to the numbers which have been disclosed as of 31st March?
Definitely, there's been a reduction in that. But because we can talk about the full fiscal, and that's why I'm saying in significant decrease you will see in the coming quarters is based on that same thing.
Okay, thanks.
Thank you. The next question is from the line of Jayesh Shah from OHM Portfolio Equi Research. Please go ahead.
Hi. Thanks for the opportunity. Am I audible?
Yes, sir, you're audible.
Okay. I think the first question is again on the debtors issue. What are generally the payment terms for government and insurance?
So for the government, usually anything between 90 to 120 days, I mean, that's kind of the agreement, right? And for insurance goes around 45 to 60 days. So this is what on a paper, right? But we have seen it, particularly the government side. If you see, once they start to give you payment, that at one go, I mean, there's so many backlogs get clear. So sometimes it's a 2-3 months, 4 months delay. We have experienced this in previous years as well. So I don't think so. But this next coming 2 quarters, I think you will see a drop in these numbers, right? But yes, I think we are keeping eye on it, and the team is working to see this, how to reduce this number.
So are you able to confirm to us how much has got liquidated till now, which is 20th May, out of 220 crores?
So that is something I think that can be individually shared, would not be right to share on a call, public call like this. But when we're saying that in the Q1 of the new fiscal, there will be significant reduction in the debtors. So that is, yes, there are some liquidation have already started happening.
I would request, this is a very important key number. So if you share publicly, I'll appreciate. Otherwise, I would like to get this offline.
Sure. Okay, we'll reach out to you this time.
Okay. Secondly, out of this 220 crores, how much of debtors are more than 6 months?
Well, for that, often I'm not remembering, but yes, because the accounts are being done, so we will be uploading our full balance sheet.
We'll share that offline with you, and then we can speak out to you.
In quick of time, we will share it.
Okay. Because of this debtors level that you have on the government business, what is the price difference between what you sell on cash or insurance versus government?
So usually, typically, the cash rates are, so let's say private insurance rates are somewhere close to 20%, 15 to 20% lesser than the cash rates. And then even the government rates from the private insurances would be 10 to 15% lesser. So roughly around, I would say 25 to 30% lesser is what government rates are compared to a cash rate. But then, of course, that also depends upon the case mix. So as we said, the reason why we are okay with doing this business now is because our super specialty, especially oncology, when that's increased, in oncology, the rate difference is not 30%. It is much, much lesser than that. So that's how the government business works.
Understood. And in your own targets, over next 1 or 2 years, this government business, will it continue to be between 30-40% or it should come down?
It should come down. It will come down. See, today we have occupancy to ramp up, right? We can take it. But, once if given a choice between a cash and insurance patient, and if you have restriction on the number of beds, then, priority is always given to other segments.
And Jayesh, I would add, so as of now, we have got negligible share of international business as of now. And we have set up a dedicated team, so there should be a traction in that, which should automatically bring up the cash category business and reduce the government share. And we are pretty confident. We have hired the best team in that department. So you will see those results flowing in the quarterly numbers.
Fair enough. I get it. Lastly, what is the annual rate hike that you would normally get?
So,
is it as per
usually
inflation, higher than inflation as to, 9-10%? Because you just mentioned, about some annual increase that you get in our hospitals.
So the cash patient, if you see, it's like, as I said it earlier, so every year there are, the corrections on the schedule of charges which you do depends on the, the services and the kind of utilization and also the various, your competitive analysis, what you do it. So, but I think roughly, so it has a various factors when we change it, just not only the inflation. So I think roughly I would say around 6-7% can make an impact on the cash patient, 6 to 8% kind of.
Okay. And on insurance and government, do you get annual increase or how the rates are being done?
So insurance, it totally depends on, there is a one-to-one negotiations happens with the, it's GIPSA who does negotiation on your current card rate and your previous, the GIPSA rate, right? So keeping those two rates in mind, and then you have a negotiation and you try to get by showing the, good volumes and others. So this is how the negotiations happens.
I see. And they're normally for what? For a period of 2 to 3 years?
Sorry, come again?
Are the rates fixed for 2 to 3 years for insurance?
2 years. 2 years, but the 2 years for a GIPSA, for a government insurance company. For private insurance, totally depends on one-to-one negotiation, be it 1 year or 2 years. Totally depends on your, discussions with them.
Right. I guess, I think that's it. Fantastic numbers. In a way, which is why you have more questions coming on the cash flow because the profits have not really got converted into cash flow. But hope to connect with you offline. Thank you and best wishes.
Thank you.
Thank you. The next question is from the line of Rohan Advant from Pratt Capital. Please go ahead.
Yeah, thanks for the opportunity. Just one question on the margins. If I look at EBITDA margins, sequentially, they have come down a bit in spite of a good sequential pickup in the revenue, and that's largely led by, I think, the increase in consumables. So what has caused this? Is this the payer mix that has caused it or something else?
So the margins is, a point here and there is not that of a significant difference, but yet, yes, there has been increase in the material consumption consumables. That is because, now we are, as we are shifting towards more super specialized treatments like, transplant program, oncology, cardiac. So more consumable cost is required for these super specialized treatment, and that is one of the reasons for just a minute dip in the EBITDA margins. But we are confident that we still feel that these EBITDA margins are at an optimized level, and these should be sustainable in the quarters ahead.
Okay, so next year we'll have the new 200-bedded hospital that we've acquired coming up. So there could be some upfront cost there. But in spite of that, this 27% kind of EBITDA margins for FY'25 you think are sustainable?
Yes, quite sustainable because the existing other hospitals that we still have the occupancy to ramp up, the EBITDA margins will grow. So in overall consolidated level and group, the margins would be sustainable.
Got it. Thanks and all the best.
Thank you. The next question is from the line of Madhav Agrawal from SG Investments. Please go ahead.
Hello.
Yes, sir.
Hi, thank you for the opportunity. Could you give some guidance on how we are seeing the Asian Fidelis to ramp up during the current year and the next?
So we feel that the ramp up should be very, very soon there. This hospital that we have just started this month itself, in the month of May. And, all the doctors are already recruited there. We are just, waiting for the cardiac machine cath lab because that is something it was not having earlier, as well as an MRI. So that is why, we did an additional capex of close to 35 crores. So only those two machines are remaining to reach the hospital, and then the full cardiac as well as the radiology department will be ready there. So we feel that because the health insurance is already there, some star doctors are there, this hospital, should ramp up very, very soon. And we are quite confident about the geographic area, about where the hospital is located.
Okay. What kind of occupancy are we targeting for FY'25?
See, I think the hospital where it is, we already have a strong brand presence there. Faridabad is one area where, we are also quite present in Delhi NCR market. So, some of our doctors are from there. Some of the patients were already coming to a Noida hospital from Faridabad. So we feel the occupancy there should ramp up very, very soon. Let's say what we feel is, what Jhansi is able to do in a couple of years in occupancy. We feel that Faridabad should be there much, much more earlier than that, probably in a year. So we feel quite confident of the occupancy at Faridabad hospital.
Okay. Also, could you tell me what's been the improvement in our international patient volume?
International patient volume has been increasing, given the fact that, we have done around 150 kidney transplants and in last year and a half, and 90% of those kidney transplants are international patients. We are, now also targeting international liver transplant, international bone marrow transplants. This is already infrastructure has been renovated to cater to those patients. There's been new professional marketing team for international patients that have been recently, joined us from a Delhi NCR hospital. So we feel that, in the years to come, international patients should be contributing close to a double-digit, contribution in our overall revenue. And we are quite confident at big time that is what we are targeting in the times ahead.
Okay. So what kind of steps are we taking to change our payer mix, since we have a significant share of the government business for around 40%? What would be our aspiration like 3 to 5 years down the line?
As Yatharth illustrated, that these numbers as a government business, it's around contributing 35 to 40% as of now because we have a bed capacity there. So as these, bed capacity scarcity gonna come and more super specialty. See, if you look at it, what we have said that at the Noida Extension Hospital, it's a story of around 24 months only, and that's the kind of super specialty you see. So word of mouth is spreading very rapidly. That catchment area has grown really, at far. So we expect that as we move into the tier 2 and tier 3 cities and patients coming from those regions, and those patients are mainly, if you see this for cash or TPA segment. So, in fact, our up-country marketing and the kind of couple of OPD centers we are setting up in various parts of the country. So, we believe that this segment bound to grow, and that since these two segments will grow, and the third segment will automatically go down. So, as of now, it is not significantly impacting, and that is what I think you see this number.
Okay. So my last question would be, as you mentioned that we are planning to add a hospital every year for a couple of years going forward. How do we plan to fund those? Are we looking to take up some debt as well, or are we focusing on internal accruals to fund this?
So it'll be a mix of both. Our finance cost has gone down significantly, so the internal accruals are more now. So I think we'll be able to fund it, a mix of that as well as a debt. But I think overall we still feel because there's a strong cash position also at the balance sheet. So overall net debt will still be net debt free, even with a certain little bit of debt.
Okay. That's all from my side. Thank you so much.
Thank you. The last question is from the line of Sunil from VK Investments. Please go ahead.
Good afternoon, sir. Am I audible?
Yes, sir, you're audible.
Okay. So I had a question. In your financial statements, there is a footnote mentioned where an income tax has frozen 70 crores of our amount and created a lien on the bank for that specified amount. I'd like to know that when was this done, and going forward, won't it affect our growth since our capital is going to be blocked, and for how long do you think would it be blocked? That is my first question.
Yeah. So, we had already informed the stock exchange in October 2023. We had people coming from income tax. So they found that we had that was, because we were through with the IPO money and, a lot of cash we had been having, which was basically for the specified purposes. So in the zeal of things, they had, kept this money. Now this money is with us. They have not taken it away. It is still with us. So it's not that, they have taken this money away. Now your second question that when are they going to settle it? We wanted to settle it. We had done our things with them. But interestingly, this investigation team, they said that they don't have any assessment right. Government procedure, we can't help it. So we are already with the next stage now on the assessment thing, and we have been told that, because not much of the things were there, so very quickly, they haven't given the timelines that when they are going to blast it. But we expect that in this financial year, that thing should be behind our back, and that this blocked money would be, given back to us. So at this point of time, it's basically freeze in our account. Account is still we are having, not that they have taken the money out.
So basically, the account is frozen. The money lies with you, but you cannot use it, right?
We are not allowed to use that much of money. Beyond that, we can, pending the full assessment by the income tax.
So would that not put stress on the working capital cycle because 70 crores?
No. See, the thing is, if you see our overall cash position, so we do have, much more lying in our cash position. So working capital is not an issue. Important is that, we should settle the, queries of income tax as early as possible and bring this money back into our system.
Okay. And sir, I'm aware of the October disclosure you all had made about the income tax search at your premises, but I would appreciate if you could have also put up a disclosure regarding the 70 crore freeze, because this just came into the financial statements now. This has been quite a few months since income tax?
It happened post our disclosure. So, we were not aware that, they have done it. We got to know it later. So because now we were finalizing the accounts, so we thought that, it would be that we should, apprise our investor in the full light.
But you feel that it should be done in this financial year?
Pretty certain. We wanted to, in fact, the agencies who had done it, they said very clearly that they don't have any assessment power, so that's why they cannot do the assessment. Otherwise, we wanted to close the assessment in this fiscal and have this money back into our channels.
So they have not found anything suspicious, you are saying, but they have done it as a procedure. They have just frozen this amount as a procedure.
Yes.
Okay. And my second question will be on the Faridabad. The OPEX cost will be higher for the next few quarters on this, since you must be hiring or must have hired, and will it affect the margin in the nearby quarters?
No, so see, any new hospital starting does require a certain investment to be done until it's ramped up. So as I said that yes, even though we do feel that margins should be dragged a bit from Faridabad, but in overall, because the other hospitals are growing, at the consolidated level, it'll still be sustainable.
Okay, so it won't really materially affect your margins going forward.
Yes.
Okay. That would be all, sir. All the best. Thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
Okay, I think thank you to Smith, and thank you for all the people who for your questions. We look forward to your next earnings calls, and if any questions are there, you can reach out to us individually and offline, and we'll be more happy to answer. Thank you.
On behalf of Smith Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.